So, in this chapter, we'll be taking a look at the definitions for national income. So, national income is usually to do with stuff like leakages, injections, and all of that kind of stuff. So, the idea in this chapter is there's actually a lot of definitions to look at, so we can just kind of jump right into it. So, let's take a look at leakages first. So, leakages are where money leaves the circular flow of income in the economy. So, this means anything with savings, taxes, and imports. So the way we can look at this really quickly is what the circular flow of income actually is if you have households over here, and here you have firms, what happens is that households will provide labor to firms, and as a result, firms also give you products, and they also give you a wage, and you give labor to your firms. So basically, that's a rough idea of what the circular flow of income is. And the idea here is that sometimes there are things outside of that which can affect it. So leakages are anything which will basically not be part of that transaction. So what happens is when you make any savings or you pay your taxes or you import stuff, then when you're saving money, then the firms are not getting it and it's not going to anyone else. So it's not really being spent in your economy, it's just being saved by you at home. So that's considered a leakage. Taxes are also considered leakage because it's not going to you or the firms. You're basically giving it to the government, and the government is considered an external kind of source in all of this. And imports are also considered leakage to the circular flow of income because what's happening is you're giving the money from your country to another country. So it's kind of leaving your country's flow of income. So that's why saving taxes and imports are all considered as leakages. Then we've got an asset. So an asset is basically an economic resource which can be used to generate income in the future and is basically an accumulation of wealth. You can think of it like, for example, buying a house, that's an asset. If you get rent on your house, then it's giving you income in the future. Then we've got wealth. So wealth is basically the value of all your assets owned by either a person, firm, government, or country, etc., etc. It's basically just all of your assets added together and the value of that. Then we've got income. So what exactly is income? Income is considered to be the flow of money, and this is often the money which is received by the individual firm in exchange for providing goods and services through investing capital. So what this means is that you might have an individual company, they will give goods and services to or for example, I might work for someone so I can get an income. Sometimes I want to buy something, so if a firm is selling something to me, then they're making an income and so on. But income is basically the flow of money, and both suppliers, producers, the consumers and market, they can all make an income. Then we've got collateral. So collateral is an item of value which a lender can seize from a borrower if they fail to repay a loan according to agreed terms between the two parties. What this means is if I give you a loan and you might not be able to pay it back and I'm not sure about that, then I'll say, fine, I'll give you this loan of £50,000. But in the case that you can't pay it back, I want you to put your car up as collateral, meaning that if you don't pay back your loan, then I can seize your car. So common things to put up for collateral, stuff like houses, cars, or anything of a lot of value. But basically, it just means the person lending the money can be sure that in the worst case where he doesn't get his money back, at least he can get an item of equal value or some money from the collateral that you put up. Then we've got injections. So injections are money which is put into the circular flow of income from outside of it. So this includes investment, exports, and government spending. So like we said before, in our circular flow of income, we had households and we had the firms. Anything outside of this is considered external. So the government is external. So if you have investment, then money is coming into this from outside, from other places. So it might be other companies, etc., investing into it. So investment is an injection. Exports are also injection because we're giving goods to other countries, and as a result, we're getting the money from these countries which are outside of our flow. So, for example, if we sell some goods to France, then we get money from France's circular flow of income. It comes into ours, so that's why it's considered an injection. And also government spending. If the government puts money in, then they're obviously putting money in from an external source. So that's an injection. Then we've got the multiplier ratio, and this is the amount by which a change in an injection or leakage causes the total spending to change. And it's basically the idea of how effectively you respend your income in the economy. So what this means is that if you have a low multiplier effect, if I do, let's say, put an injection in, then let's say I did some government spending, so firms had more money, then if the firms had more money, they might hire more people, they might make more goods, etc. The idea is that if I give money to one person, he doesn't just keep it, they tend to spend it in the economy, then that firm will do something with that money and they might make goods and services, etc. The idea is that for every pound I put into the economy, how much does it get respent? And the more it gets respent in the economy, the higher multiplier ratio. So that's why company or countries with high multiplier ratios or economies with high multiplier ratios, if you were to invest a lot of money into them, then you can actually see a better effect as it's being respent even more. Whereas if they're not being respent as much with the lower multiplier ratio, then you need to put even more injections to achieve the same effect than if you had a high multiplier ratio. So then finally, we've got something called exogenous changes. Exogenous just means something outside. So an exogenous change is a change which arises outside of a system. So an increase in export earnings, government spending, etc. All those exogenous changes, basically things which happen outside of something. So for national income, that's pretty much all you need to understand. If you're revising this topic, probably a good idea to get used to the idea of the circular flow of income, because that's the main thing that you need to know this topic. If you're good with that, then this whole topic should be pretty simple. And if this was useful, just share it with your friends, and I'll see you in the next video.